You know that feeling, right? Trying to wade through all the financial news, the earnings reports. It can feel like you need a secret decoder ring sometimes.
It really can. So much jargon, so many numbers flying around.
Exactly. Well, that's why we're here. Welcome to the Deep Dive, where we take those complex reports and, well, we dive deep to pull out what really matters for you.
And today we're tackling Citigroup, specifically their first quarter earnings for 2025. We've got the official release, the investor slides, even a news piece summarizing it.
Yep, we've got the source material. And our mission, as always, is to slice through the noise, get past the buzzwords, and figure out what Citi's performance really tells us. We might even uncover a few surprising bits along the way.
Definitely. So where should we kick things off with a giant like Citigroup?
Let's start high level, the big picture. What were the headline figures? Did they hit their marks?
Well, actually, yeah, they did better than just hitting the marks. They exceeded what most analysts were expecting. Earnings per share came in at $1.96, whereas the street was looking for about $1.84.
Okay, so a decent beat on earnings. What about revenue?
Same story there. They reported $21.60 billion in revenue, just a touch over the $21.19 billion expected. So a beat on both top and bottom lines.
Beating expectations is always good news. But, is this just a slight bump or is there some real underlying momentum compared to, say, last year?
That's the key question. Looking year over year, revenue is up 3%. But net income, that jumped a pretty significant 21%, landing at $4.1 billion.
Wow, 21% jump in net income? That's substantial.
It is. And something else they highlighted was achieving positive operating leverage, not just for the whole company, but actually across all 5 of their main business areas.
Okay, hold on. Positive operating leverage. Can you break that down for us? What does that mean in practical terms?
Sure, think of it this way. Their revenues grew faster than their expenses. Or you could say for every extra dollar they brought in, the cost to generate that dollar didn't go up as much. It signals growing efficiency.
Right, getting more profitable as they grow. That definitely sounds healthy.
Yeah. It's a very positive sign. Yeah. It shows good cost management alongside revenue growth.
And I assume that efficiency feeds into their overall profitability metrics. I saw a mention of ROTCE, return on tangible common equity.
Exactly. Their ROTCE improved nicely. It hit 9.1% this quarter, which is up from 7.6% in the first quarter of last year.
So they're generating better returns from their core assets.
Precisely. It's a key measure of how effectively they're using shareholder capital invested in the tangible parts of the business.
Makes sense. And speaking of shareholders, I noticed they returned a fair bit of cash to them too.
They did, about $2.8 billion in total this quarter. That was split between share buybacks around $1.75 billion and the rest in dividends.
Which usually signals confidence, right? That they feel good about their financial position.
Generally, yes. Returning capital like that suggests they believe they have sufficient funds for operations, investment, and rewarding investors, and is backed up by their capital levels.
Yes, the CET1 ratio. How did that look?
Very solid. Their common equity Tier 1 capital ratio was 13.4%. That's comfortably above the regulatory minimums.
So that's their buffer against potential losses.
Essentially, yes. It's a core measure of a bank's financial strength and resilience. Having it well above the required level is definitely reassuring.
Okay, so profitable, efficient, well-capitalized. Anything else jump out at that high level?
One other metric worth noting is their tangible book value per share. That went up by 6% compared to last year, reaching $91.52. So the underlying value per share, stripping out intangibles, is growing steadily.
Got it. Okay, that paints a pretty encouraging overall picture. But Citi is massive, lots of different parts. How did the individual business segments perform?
Right, let's break it down. We can start with services that includes Treasury and Trade Solutions, or TTS, and security services. This was a real standout area.
Stand out how?
Well, the CEO, Jane Fraser, actually called it their best first quarter for revenue in a decade.
A decade, wow. Okay, what was driving that?
Mostly the strength in PTS. They also pointed out they're ranked #1 in that space. And their security services is #1 in direct custody. Overall, segment revenue was up 3% year over year.
Impressive rankings. Any other signs of strength there?
Yeah, they saw cross-border transaction values climb 5%, and U.S. dollar clearing volumes were up 8%. It's a huge engine for them. And the ROTCE in services was really strong at 26.2%.
26.2%. That's huge. So that transaction processing side is clearly a powerhouse.
Absolutely. It's a core strength.
Okay, what about markets? the trading side of the house.
Markets also had a good quarter. Revenue there jumped 12% compared to last year. They said that was driven by, strong client activity and being able to monetize that effectively.
And within markets, equities, fixed income.
Both did well.
Yeah.
Equities revenue was up a hefty 23%, and fixed income saw a solid 8% increase.
And where do they stand competitively in markets?
Overall, they're ranked number 3. Fixed income is number 2, which is very strong, and equities is tied for number 6. The ROTCE for the market segment was 14.3%.
So pretty solid performance and rankings there, too. Moving on to banking. This is investment banking, corporate lending, right?
Correct. Banking revenue was also up 12% year over year. The really eye-catching number here was M&A advisory revenue. It nearly doubled compared to Q1 last year.
Doubled. That suggests a big pickup in deal making, or at least their share of it.
It certainly points that way. Overall investment banking revenue rose 12%, heavily driven by that 84% surge in advisory fees.
But was it strong across the board in investment banking?
Not entirely. The report did mention declines in fees from equity capital markets, ECM, so IPOs and follow-on offerings, and debt capital markets, DCM.
Interesting mix. Strong M&A, weaker capital raising, and their ranking.
They're ranked number 5 overall in investment banking, and the banking segment's ROTCE came in at 10.7%.
Okay. Now, wealth management. That's been a main focus area for many banks. How's Citi doing there?
Very well this quarter, actually. Wealth revenue shot up 24%. They mentioned seeing good progress across all their client segments, the private bank, wealth at work, and Citigold.
24% is impressive growth. Any specific highlights?
Yeah, their private bank got named North America's Best for the Next Generation by Euromoney for 2025. That's a nice accolade.
Definitely. What's fueling that revenue growth? More clients, more assets.
Both, it seems. Client balances were up 7% year over year, and maybe more importantly, net new investment assets. So new money coming in was up 16%. The ROTCE for wealth was 9.4%.
Strong growth in attracting new money.
Yeah.
Okay, last main segment, U.S. personal banking, or USPB, the consumer side in the U.S.
Right. USPB saw revenue growth too, but more modest, up 2%. This was mainly driven by their branded cards business and their retail banking operations.
And they have strong positions there, right?
Yeah. They highlighted branded cards as ranked number 2 in the U.S., and retail banking is apparently number 1 in deposits per branch, which is an interesting metric.
Deposits per branch? Okay. What drove the revenue growth within USPB?
For branded cards, revenue climbed 9%. That came from growth in interest-earning balances, people carrying balances, and just higher spending on the cards overall.
And retail banking?
That saw a bigger jump, revenue up 17%. That was mostly due to higher deposit spreads, basically earning more on the deposits they hold. The OTCE for USPB overall was a healthy 12.9%.
Okay, so solid performance, maybe some areas stronger than others, but generally positive across the board. Beyond the quarterly numbers, what's the bigger strategic picture here? What are they focused on going forward?
They're really hammering home the focus on those 5 core interconnected businesses we just walked through. They keep saying the strategy hasn't changed. A huge piece of executing that strategy has been exiting a lot of their international consumer banking businesses.
Right, they've been selling those off for a while now.
Exactly. They mentioned that the exit from 14 of those markets is now largely complete. That's a major undertaking, simplifying the bank significantly.
And freeing up capital and management attention, presumably.
That's the idea. And it ties into their broader simplification efforts, streamlining the organization, the management structure. It's all about making the bank less complex and hopefully more efficient and profitable.
And technology. Every bank talks about tech transformation. What's Citi doing?
Definitely a key focus. They highlighted progress in transformation and specifically called out increased use of generative AI.
Gen AI. How are they using it?
They give a few examples, things like improving efficiency, productivity, customer support, risk management. They mentioned a pilot using Gen AI for call routing and customer service.
Okay, so getting customers to the right place faster.
Potentially, yeah. And also things like automated code reviews for their software developers, which could speed up tech development. They also mentioned retiring 130 old applications just in this past quarter.
130 apps gone in one quarter. That sounds like serious modernization work.
It suggests a real push to update their underlying tech infrastructure for sure.
Interesting. Now, shifting gears a bit, what's their take on the broader economy? Any notable comments from the CEO?
Yeah, Jane Fraser reiterated a pretty bullish view on the U.S. dollar, actually. Even though it's weakened a bit recently, she expressed confidence that the U.S. remains the world's leading economy and the dollar will stay the key reserve currency.
sticking firm on the dollar's dominance despite some global shifts?
Yeah, she linked it to eventual resolutions of trade imbalances and other structural factors. It's a confident long-term stance.
Okay. And what about their own financial outlook for the rest of 2025? Did they change their guidance after this strong quarter?
No, they actually kept their full-year guidance unchanged from what they'd previously stated. They did add the standard caveat that it depends on macro conditions, of course.
So they're not getting ahead of themselves despite the good start. They're sticking to their plan.
Seems that way. The guidance still centers on their expectations for things like net interest income, excluding the markets business, and overall revenue.
Gotcha. Let's circle back quickly to some of those financial health indicators. You mentioned the efficiency ratio improved.
Yes, significantly. It came in at 62%. That's about 490 basis points, or 4.9 percentage points, better than the same quarter last year. It really ties back to that positive operating leverage we talked about, costs being managed well relative to revenue.
Right. And what drove the overall expense reduction? You said expenses were down.
Yeah, total operating expenses dropped 5% year over year. The main drivers were lower compensation costs, helped a bit by favorable currency exchange, and also the absence of a big restructuring charge they had last year.
But they're still investing, right?
They are. They noted that some of those savings were offset by continued investments, particularly in technology and also in marketing.
Okay, so cutting costs in some areas, maybe from past restructuring, but still funding growth initiatives. What about credit quality and potential risks?
Credit costs were $2.7 billion for the quarter. That figure includes net credit losses, particularly in their card portfolios, and also a build and increase in their overall allowance for credit losses, the ACL.
So setting aside more money for potential future loan losses.
Exactly. They explicitly linked that ACL build to ongoing macroeconomic uncertainty. So while results are good now, they are clearly being cautious and provisioning for potential bumps down the road.
A prudent approach, given the environment. And just quickly, the balance sheet basics. Assets, loans, deposits.
All showed modest growth compared to the prior quarter and last year. End-of-period assets, loans, and deposits were all up slightly, and their supplementary leverage ratio held steady at 5.8%.
Okay, and one last detail. There were some mentions of adjustments, divestitures impacting the numbers. How should we think about those?
Right, it's important to acknowledge that the reported numbers do include some noise from those ongoing market exits and also a special assessment from the FDIC.
So not purely comparing apples to apples with last year in some respects.
There are some comparability factors, yes. But Citi was clear that even if you adjust for those items, the underlying trends in their core businesses generally remain positive. They also noted a presentation change for some fees, moving them from expense to a revenue reduction, but stressed it doesn't change the bottom line, the net income.
Okay, so some moving parts due to these strategic shifts, but the core engine looks solid underneath it all.
That seems like a fair assessment, yes. The fundamental performance appears strong.
All right, great. So let's try and pull this all together. If someone listened to this whole deep dive, what are the main things they should walk away with about Citi's first quarter?
I'd say three key things. First, a strong start to the year, definitely beating expectations. Second, broad-based growth across most of their core businesses, showing their strategy might be paying off. And third, clear progress on their simplification and tech initiatives, alongside a confident, if cautious, outlook.
Yeah, it feels like they're executing on that simplification plan, and we're starting to see some of the benefits in the numbers like that improved efficiency ratio.
Exactly. And digging into the details, like the specific drivers in each segment or the nuances around expenses and credit costs, gives you so much more context than just the headline beat.
Absolutely. You see how they got there, not just that they got there.
Which is the whole point of doing this deep dive, right? To get beyond the surface level.
Totally agree. Okay, so as we wrap this up, here's something to maybe mull over. We heard about Citi's big strategic changes getting out of those international markets, doubling down on tech like AI, plus the CEO's strong stance on the US dollar. What could the long-term ripple effects of all this be? For the wider financial world, and maybe even for us as individuals, whether we're customers, investors, or just watching the economy?
That's a great question to ponder. How does a giant like Citi reshaping itself potentially alter the competitive landscape or even influence global capital flows down the line?
Definitely food for thought.
Yeah.
And exploring those kinds of questions is exactly what we try to spark here at the Deep Dive, taking this complex info and making it hopefully insightful and accessible.
It's been a good look at a crucial player in the financial system.
Indeed. Thanks for joining us for this deep dive, everyone. We'll catch you on the next one.